Hello, everyone, and welcome to our property selection process with our investments team here at Arrived. We'll give everybody a minute here just to file in. In the meantime, would love to hear where you all are tuning in from. So I'm tuning in from sunny Seattle today. I'm seeing Los Angeles, Seattle, good to see you, Ethan, San Diego, Miami, Costa Rica, wish I was there, Salt Lake, Boston, Whitefish, DC, love to see it. Coast to coast and even further. We have some teammates in here as well from Arrive, so you'll be able to see them. We'll also be dropping some polls today. And for everybody on the line, these polls are circulated within our company. We utilize them to drive product updates, changes, so on and so forth. So we are thrilled to have you all here today. I'll give another 30 seconds. Ooh, Houston. I should have asked if there's a place you would like to see a property, let us know in the chat. These are all good recommendations as well from where you're residing. Palm Springs, ooh, good spot. Abby. New York, Aspen, ooh, love Aspen. UAE, good to see it. All right, we will shift through here. I do see somebody's having trouble hearing. We do recommend an incognito window. If you can't hear me, Jake will be able to drop that in the chat, but we'll get started here. We're thrilled to have you all join us today for the property selection process with Arrive's investment team. Joining us today will be Cameron Wu, our VP of Investments, Jeff Talbert, our Director of Investment Valuation. Fun fact, they both worked at American Homes for Rent together, and thrilled to have them here today. Jake Pruchno, our Business Operations Manager. Jake will actually be live in the chat, so I wanted to highlight as he'll either be answering those questions or teeing them up for live Q&A at the end. We will try and circulate a lot of questions that pertain directly to what we'll be chatting about today, so when we're circulating properties and bringing them onto the platform. And then again, my name is Corinne Headland. I lead our investor relations team here at Arrived, and we're thrilled to see you all today. Sean, thrilled to see you bought shares of the Cypress. We'll also be releasing another property for you all to invest in live today as well. To set the stage, we'll be walking through our market, the underwriting process, home specifics, and then live Q&A for you all. So I'm going to welcome Jeff Talbert up to the stage, and he is going to kick us off.
Thank you, Corinne. Appreciate it. This is actually my first time doing a webinar. So hello to everybody. I actually began kind of my relationship with Arrived when I was an investor last year in 2021. Loved the product. And yeah, I joined the team. Really excited to be here. And now I get to help curate some of the investments for you all and try to find really great properties to invest in. So today we are going to be launching the Harrison, which is in Ooltewah, Tennessee, basically Chattanooga, Tennessee. I believe we actually are launching this property right around now. So the shares should be available on the website for purchase. And I kind of want to walk through our property selection process. And to me, one of the main ways that starts, as you can see in the chat, is kind of where are you going to buy properties? Where are we going to invest? So I want to talk a little bit about Chattanooga, Tennessee. It's a place that I think probably not everyone is necessarily familiar with, kind of where it's located. Just to give you a general idea, it's about an hour and a half northwest of Atlanta, an hour and a half southeast of Nashville. So kind of right smack in between the two. Really great city with some really interesting history, like recent history. So Chattanooga, Tennessee, kind of the one very interesting thing about it is the city has made a lot of incredible investments as a city. And so I believe around 2010, they began laying fiber optic for their entire community, and they became one of the only one of the only cities in the country to have municipal fiber for all their residents. Very forward thinking. And then a few years later, they actually began building out a smart grid. Again, one of the first in the country, and certainly not something you would mentally associate with a city by a river in central Tennessee or southern Tennessee. So I guess the reason I bring these things up is this city is very forward thinking. They invest a lot in their future, and that's paid off. That's paid off really handsomely for them. So they've gotten investment. If you look at the map here, you'll see they've gotten a lot of investment from Google, Amazon, Volkswagen actually fired up a plant there, and they're going to produce, I believe, 7,000 electric SUVs there, or something like that. So they're getting a lot of investment in there. And the reason we bring these kinds of things up, and the reason these are the kind of areas we look for, is we look for areas that are going to grow. We look for areas that are going to have population growth, job growth, et cetera. Chattanooga has maintained unemployment well below an unemployment rate well below that of other of the national average. So really excited to be in this area. Also want to point out on this map, you'll see right in the middle there's an airplane. So that's the airport. Another thing you have to think about when investing in real estate is kind of access to an airport. That makes an area much more desirable, makes it much more likely for big businesses to want to move there. Chattanooga has been expanding its airport. It's adding a terminal. So a lot of growth here. It's a very interesting story. Towards the upper right, you will see that they have, you'll see our house. It's in Ooltewah, so it's in a nice suburb of Chattanooga. And yeah, really excited about this area. And I'm going to, again, maybe you were expecting immediately to jump into the property, but I just kind of wanted to reinforce how the market selection is a really key piece of that. And I'm going to hop off stage and let Cameron kind of dive into the exact numbers of the Chattanooga property. And then I'll come back on and tell you a little bit about why we specifically liked this property. So Cam, I'm going to hop off and let you take it away.
All right. Thanks, Jeff. Hey, everyone. Thanks for joining today. So I wanted to take you through our underwriting process, right? This is really the key economic kind of process that we have in place that helps us identify properties, figure out what is the best rental asset that is out there, because not all single family residential assets are created equally in terms of their ability to be a good investment as a rental property. And then after we go through that entire process, so that we're looking at all of the data and how we use both data and a very human process to select those best investments. We'll go specifically into the property, look at our rent estimates, and give you a good idea of what rental economics look like. So any specific outcome, I wouldn't look to use it as guidance for the exact specifics of this investment, but I would use it as a general guideline on how to think about investment cash flow and what we look at. So let's start with what is the process, right? And there's kind of a double five, when actually that should be a 6-step process of levering and refining. But let's start with ingesting. So what does that mean? We have a couple of different data sources where we're ingesting public listings in our markets, as well as off-market listings from some data service providers and wholesalers, such as Opendoor, OfferPad. Some of those businesses really specialize in those off-market listings and then partner with companies such as ourselves to distribute that off-market inventory. Then we narrow down that world of listings, right? So we apply rental return models, we use industry tools and data services to narrow down the world of investment selection to those with the best mechanically underwritten return profiles. Because, we're talking about thousands of properties at any given time, especially with the number of markets that we're in. So we have to start somewhere with an efficient mechanism to pare down the world. So we can immediately get rid of a couple of properties that wouldn't work. So let's say that we're in a lower cost of living market, and we're saying, okay, we know that homes that are over $700,000 don't tend to be good rental investments because they can't generate enough rent. Like there's not enough tenants out there who are able to pay a high enough rent to warrant spending $700,000 on a home to use it as a rental. Right. So we exclude those, and we have a number of rules that act as exclusionary principles where we can say, all right, let's narrow it down. And then from that point, we really start getting into the human element of the process. So when we're analyzing rent and when we're looking at property taxes and HOA fees, a lot of this information is very specific, and you would be very surprised at how non-uniform and non-accurate some of this information tends to be. Such as HOA fees, right? Because a lot of information within real estate is not aggregated in one place. It's very disparate because HOAs, they are little kingdoms in their own right? So they have all this information about fees and rules. So working with single family residential long-term rental data and those investments, it requires that you have a very human look at all the numbers once you reasonably identify what looks good. And that's what we start doing. And the most important number really is that analyzing the rent, because it's the key driver of that cash flow. So the investments team at Arrive, we're largely versed in rental economics of single family residential and the long-term rental operating model in general. So that's where we choose to focus a lot of our expertise is in getting those rent numbers correct, and that's what will drive that cash flow. And then we get into even more human elements, like what do humans do better than machines? And largely, I think it's synthesizing and processing visual information, as well as just having that body of context of living in life, knowing what is attractive to people, what do people like. Do people want undermount sinks with granite countertops? So like knowing that, identifying that, we do that so much better than machines. But machines do a really good job of narrowing down a world of data when you feel like you're overwhelmed. So we use this two-step process that really starts with get the best in breed of data to help us focus. And then once we focus, then we're going to be even more discriminatory in looking for those high cash flowing properties in great neighborhoods, right? And then we're also going to make sure that we're looking at the satellite imagery. We look at the street imagery, right? We zoom in, we zoom out, we do that bird's eye view and kind of rotate around the neighborhood to make sure it looks good. We check the neighbors to make sure that they take care of their homes. All of those are really important decisions in making an investment in residential assets, because you're going to be selling these later 7 years down the road to who? Probably an owner occupant who's willing to pay top dollar for those neighborhoods that we're in. And that's really what we're going for. So once we decide we like a property, we think that the cash flow, that the economics of it work, we determine the appropriate financing structure. So that's leveraging a property, that is getting the mortgage, right? Plenty of properties we do unlevered. Plenty of properties we take out a modest conservative loan on it to help get equity appreciation. In some of our other webinars, we've gone through what is levered equity appreciation. I'm sure the question will come up, why get debt on an investment? And happy to go through that in the Q&A, but that's kind of one of the last steps of the process of determining the finance structure to get that best return. And then as we go through the process of being under contract, we keep modifying the underwriting, because as we get more information specifically about the property, such as through our inspection, we're updating the budget necessary to support the investment. So that's the underwriting process at a high level. And, we build a lot of tools and hire industry expertise to facilitate that. Now, let's go through the actual example of this property, the Harrison. What we have here is called a net operating income and cap rate model. This is kind of the gold standard of the way that you look at rental economics. And it basically says, what is the cash flow? So we're not factoring in taxes. We're not in the sense of income tax. We do factor in property tax, but not income tax, because depending on who owns the investment, there will be different income tax consequences. So we try to not look at that, nor do we try to look at financing. We're just saying, this home, how good of a job does it do that producing cash flow? So we start with the rent number. So we underwrote Caney Ridge Circle, the Harrison, to be about $28.95 in rent, just under $3K. So, you could expect a little variation in there, but around $3,000. So as we go through the underwriting model, there's two generally large categories of expenses. One of them is called controllable operating expense, OPEX, and the other is called uncontrollable OPEX. So on the first part, controllable, well, what is within your realm of control? You can control your vacancy. So if you have a really low price, you could expect very low vacancy. If your price too high, you could expect higher vacancy. But it's an economic cost. So when we look at that rent number, we're looking at it like we're not going to get all of it every single month because, once every couple years, we're going to have to go through another marketing cycle. So we have to allocate some amount of loss of cash flow, which we call vacancy, during the marketing period. Next, we have maintenance, and we have those underwritten around 6% of rents. So you would expect to spend around $2,000 on a 400-ish $1,000 home on any given year with just various issues. And it's not going to happen very linearly over time. It's not like every year it'll be $2,000. It may look like $0, $0, and then $6,000 upon a move out, averaging out to be that $2,000 per year. And that's kind of a general comment about underwriting cash flow, is that it doesn't occur in a very stable way, but we look at it over a 5-year, 7-year, longer term horizon and use our industry expertise to know about where do the chips fall in terms of the percent margin that these items cost. So with maintenance in our year vintage of the type of home we purchase, it's around that 6%. Property management, we underwrite at 10%, even though the rate is at 8%. And here's why. Just, this is property management information for you all. In addition to the fee that a property manager charges for collecting rents and managing the tenant and leasing, there are ancillary fees, such as lease-up fees, that go into this number. So they may charge 50 to 75% to lease the property, 50 to 75% of 1 month's rent. So if a rent is $2,000, then they may charge $1,000 as a leasing fee. But, a tenant would stay for 3 years, 4 years. So it's not like you're paying that every year. It would be a cost that is spread out. So as we go through all of these line items, right, your total controllable OPEX ends up being about 20%. And then on total uncontrollable OPEX, those are additional things like, no matter whether you're living there or you're operating it as a rental, doesn't matter. The fact that you own it and there's a house there, you're going to be incurring this expense. So it's property tax, insurance, and HOA. Those are your 3 large categories. Property tax depends on the jurisdiction, all over the place, but typically you're going to pay 0.5% of the market value, up to as high as 3% in very heavy property tax jurisdictions. And then insurance, of course, you need that to protect your investment in the asset. And then HOA, you're paying that regardless. It's the monthly buying cost to live in that area. So all in all, when you take the cash flow of the rents and you take away all of the expenses, you end up at a net operating income that gives you about a 4.5% to 5% return, depending on how the actual results play out. Now, again, the specifics of this property are not the important part. What's important is looking at the NOI model and then the margin. So what we mean by margin is what percent of the cost is that as a percentage of revenue. So for example, if you had $100 revenue and a $10 cost, you would say that that item has a 10% cost margin. So when we're looking at net operating income, we're looking at a margin of about 61.6% of profit, meaning if I collect $1 of rent, I expect anywhere from 60 to 65 cents of retained cash flow. Everything else is actual cash flow that goes out the door or that I allocate for, like vacancy, because vacancy is not like a cost that comes out. It's more like a revenue that doesn't come in. So that, but nonetheless, it's still affecting cash flow. So a lot of numbers here, but that's a basic primer on cash flow economics and on NOI using this property specifically that, as a rule of thumb, for every $1 of rent that we're going to collect, we'll retain 60 cents. So that's kind of your expected cash flow number. And then when you divide it by the purchase price, that's kind of your yield, because you say, I got to buy this asset for $460K, and then I'm going to get $21,388 per year on it. And that's how we get to so one of the fundamental numbers of return economics, the capitalization rate. So a lot of information there. This will be available in the slide, so you can go through all the numbers. But that's what we do on every single one of our properties as we're underwriting them, is going through this analysis after an extensive process of verifying information from a very human element point of view, and then also starting from kind of best in class third-party data that helps us narrow everything down. So with that, I'll turn it back over to Jeff to go over more of the specifics of why we liked the Harrison and some of the features, because then you'll get a sense of, well, what makes a good rental home. So thanks, and I'll see you back in Q&A.
Thanks, Cameron. Appreciate it. So we kind of wanted to show you the math. I think a lot of people think of underwriting as what Cameron just talked through, a lot of the financials. But with our experience, there's a lot of softer aspects. Cameron referred to them as the human elements of underwriting that I think are a lot trickier, and really make or break if it's going to be a good investment. So a few things here. I'm actually going to go right to left here. So let's start with the schools. When you think about schools, I think people in general like good schools. I think they're like, oh, that's a good neighborhood. But you have to think about the kind of people that are living in an asset. So if you have a large house, such as the Harrison, you're going to want to have good schools here. This is probably the type of house where a family is going to rent it. We'll go through some other aspects of this home in particular that make this kind of a family house. And this home actually serves as a perfect example. So if you look over here at the school ratings, you'll see that the elementary school is a 9, the middle school is a 7, and the high school is a 4. So what does that tell you? Because you could say, well, there looks like there's some good schools, but the high school may be a little bit more iffy. What this typically means is you've got the best neighborhood in a high school district. So if you have a elementary school that's rated a 9 or a 10 and a high school that might be a little bit lower, that tells you that you're probably buying a house in one of the best neighborhoods in an area. So this is something that really attracts us to homes. It's not just high school ratings. Sometimes you can note that when a high school is drawing in from a very broad area, but you've got really good elementary and middle schools, you're probably buying in the right spot. The next one over to the left of that, you've got the kitchen. Basically, in this kitchen photo, from a rentability standpoint, I'm seeing updated recessed lighting. I'm seeing hard surface counters that are going to last a long time. I'm seeing hard surface flooring that's going to last a long time. So when me and my team are looking at these assets, we're thinking about how do we make sure that in our 5 to 7 year hold period, we're not going in and having to replace a bunch of things. We're looking for durability. From an owner standpoint, we're looking for durability, and from a tenant standpoint, we're looking for desirability. And this home has them both, as this slide shows. To the left, you'll also see a picture of the deck off the back. This kind of teases into the next couple slides, but you want aspects of your home that are going to be relatively unique and really let tenants envision themselves living there. So a tenant's looking through this home, they see the kitchen is nice, and they also see the deck in the back, and they envision their family out there in the evenings. These are little things that help tenants select your home over a competitor's perhaps, and help yours get rented faster, which minimizes vacancy, as you saw on the previous slide. So I'm gonna go pop up to the next slide. This again is something that helps with marketability, is just little eye-grabbing details. Just little things. So if you're looking at the front door and the kind of accent that they have on the front of this house, this is going to make a house stand out in someone's mind and is going to make them rent the homes probably quicker and potentially for a higher rental amount. So me and my team look for little aspects like this to really make sure we're buying not only in the area we want to buy, but really a premium asset. You see coffered ceilings there in the middle in the master bedroom. And then to the right, you see a really great focal point with the vaulted ceilings, the fireplace. Again, you're seeing mostly hard surface flooring throughout. There is some carpet in the bedrooms for comfort, but in all the high traffic areas, there's going to be hard surface flooring. So this home not only is very attractive to our tenants, but it's also, as from a landlord perspective, hopefully the costs are going to be relatively low to maintain. We're not going to have to go replace carpet throughout the whole house every few years and things like that, which is really going to add up to expenses. And over a 5 to 7 year hold period is a really meaningful portion of investor returns. Finally, I want to look at these three things. These three are kind of wild cards. They again, this is the kind of thing that really gets people excited about living somewhere. So to the left, we have essentially the basement is a fantastic entertaining area. So you've got essentially a little movie theater built in there with a projector and a huge screen. Out in the backyard, you've got a custom fire pit. And to the right on the picture there, you've got a little wet bar in the basement. So a couple things about this. One is, again, it lets families envision movie night, game night with the kids. It lets them really feel like they understand what it would be like to live there, which is fantastic. And it's a very premium experience, which again drives the ability to get higher rent and lessens days on market. But also just think about the fact that this is a separate level. So this is kind of a walkout basement kind of area. So you could even have a split level living situation where you've got a teenager that you want to have staying downstairs, or maybe a parent or something. So this house is very large and offers a lot of opportunities for different kinds of tenants. Envisioning probably a family living here, and I think it's just a really fantastic asset. Finally, one more kind of photo we want to show you. This is an aerial shot of the neighborhood. This neighborhood in particular, you can see everyone is kind of on larger lots. Even something as simple as the fact that our house is right here, our subject property. It's kind of in the middle of the photo towards the bottom. There's a red pin on it. So you'll see that it's actually kind of up a tier a little bit vertically from the row of houses behind it. A little bit of privacy. Smaller things like this let you know that when you're going for a $3,000 rent, when you're going for a premium rent, you're buying a premium product that's going to feel like that. You're buying something where it's got the extras, it's got the nice kitchen, it's got the little things about it that they're going to help you drive that higher rent and lower vacancy as well. And with that, I believe we are about ready to open it up to questions, and I'm going to invite Corinne and maybe everybody back on stage, and we can talk through that.
Wonderful. I'm going to take this deck off. Cameron and Jeff, thank you so much for your prepared remarks. I'm seeing a whole host of questions come through the chat, so I'm excited to get to it. Just so you know, Jake is the one in chat. We might have other teammates that are trickling in to look, but Jake is primarily the one responding there. So we'll get it kicked off here. What are y'all sipping on before we get started?
Going value today. I got the Kirkland Sparkling.
Oh, what flavor, Cam?
It's lime.
Love it. What about you, Jeff?
I'm drinking Diet Coke, but I actually don't have any within reach right now, which is very, very strange for me. But I do drink a lot of Diet Coke to keep me going during the day.
Love to see it. Black coffee for me. Well, we'll get right to it. We have a ton of questions. They will either be answered in chat or live with both Cameron and Jeff. So we'll kick things off. Cameron, right at the beginning, we were able to see where all the folks are from today, which was phenomenal, but we also had some feedback on markets for the future. So maybe you could walk through why we don't have San Fran and NYC in, and perhaps what we have coming down the pipeline.
Sure. So our asset class and the model that we get in is single family residential with a long-term rental operating model. And different parts of the country have different rental to purchase price dynamics that make it more challenging to get into certain markets if you're looking for cash flow, while other markets may pose more of a challenge on the appreciation side, even if they're good cash flowing markets. Largely, we've focused on a balance. So we're in a lot of the both appreciating and pretty modestly respectable cash flow markets, like in the Sun Belt in Atlanta, Charlotte, Nashville, all those places that have seen really great growth during the pandemic. But we haven't yet been able to find the investment thesis on the asset class within, those tier one urban locations like NYC, Boston, San Francisco, even Seattle, in our own backyard here. A lot of the team lives here, and we don't have the investments in Seattle because it hasn't fit the profile of the assets that we're looking to deliver on a balanced basis. Now, with that said, I think that there are other very, very closely related asset classes that help you get there into those markets. And I'm thinking small multifamily. So 2 to 4 units, maybe 8 or less. In those cities, they can work. They can produce the cash flow because they have revenue density. When you have single family residential, if you have a lot of land, like that's okay. You can spread out lots. But when you're in an urban core of a city, land is so expensive that you got to get density. So that's why single family residential as a long-term rental operating model doesn't produce great cash flow in areas where land is extremely expensive because you don't get revenue density. So everything else is expensive, but you're not generating enough cash because when you think about a tenant base who's living and paying for those rents, they are going to be of more median household income as opposed to the upper end to pay a $4,000 rent. So that's the challenges associated with going into those markets that have $1,000 per square foot prices on homes, even in the suburbs. So I'm not even talking about San Francisco proper, but any suburban area of that, you are looking at literally $1,000 or more per square foot in many areas, right? So it's tough, and I think that we are wanting to get into those areas because we see ourselves very much as a national company, as offering access to lots of different investment classes for all sorts of people across the country with different goals. And I'm confident that we're going to find the right entry play through something that's a little bit more revenue dense than single family residential.
Definitely. And I saw Kyle mention Vegas. I want to see that in the future. Cameron used to live there, so near and dear to Cameron's heart. Seeing quite a few questions flow in about leverage. We did just release a new filtering options on our invest page. So Cameron and Jeff, if you have any color as well, we'll kick to Cameron first. If you could walk through what leverage is, and then perhaps like the benefits of levered versus non-levered. I know we had like Brandon, Mohammed, Kevin, who had asked this in a few different ways. So I want to make sure we cover that.
Yeah, absolutely. So leverage is a mortgage. And in Arrive's history, we started off offering all of our investments with mortgages and with leverage. And then we eventually heard investor feedback that said, hey, do you have properties that don't have any leverage? We're wanting to invest and not take on any sort of debt. And we said, sure, it makes sense. So from that point, we've kind of committed to having a wider variety of investment offerings. And even in a higher interest rate environment, though, like what we have right now, where mortgages are north of 6%, it still makes sense in some cases to get debt. So very quickly, why take out debt? Because it seems like it's an expense without much benefit. And I think that's the way that debt is often viewed, is that it's a necessary evil, but if you didn't have to take it, you wouldn't take it. And with real estate, that tends to, that can make sense, but there's another reason why you would want it. And it's called positive levered equity appreciation. So that was a mouthful, but what is it? So it can probably be best explained through an example where you buy $100,000 house and you use all of your own cash that you've saved up. And let's say 5 years later, you sell it for $140,000. So you made a 40% return, right? So 40,000 divided by $100,000 that you purchased. Okay. Now let's say in a parallel universe, same home, everything else, except you got a mortgage, right? Let's say you borrowed $60,000. So you only put down $40,000 of your own money to buy that home. And since we're in that parallel universe, you still sell it for $140,000 5 years later. So you made 40K, but you only invested 40K to begin with. So you made actually 100% return instead of 40% return over those 5 years. And that's the reason to take out debt, because when the bank funds the initial purchase buy-in, you have more cash in your bank account and left over to deploy it in other ways or to reserve it if that's what the requirement is. So it gives that flexibility to amplify the amount of return that you have on your own cash. And that's why people like taking out debt, even if the rental yield is lower than the interest cost, because we may run into a situation. Let's take the example that I went through on the underwriting. There's a 5% cash flow return. But if I have to take out debt and borrow at 6%, why does it even make sense to borrow at 6% just to earn 5%? That doesn't make sense. And I agree with that from a cash flow point of view, but you're doing it for the levered equity appreciation. And there's a fundamental tenet in why you invest in SFR to begin with. And that's because as an asset class, and because it's a necessity, right? Living somewhere is a necessity, and it's in low supply and high demand. Over time, it's historically appreciated. So if you can hold on to it and if you can get the cash flow, your returns have historically been there. And it has been a winning bet to take out debt, because that debt portion got financed and magnified the returns of everybody who held on to it using debt. So that's why you do it. But of course, debt's a complicated thing, and there's a lot of risk reward outcomes. But generally, that's why you do it.
Yeah, wonderful, Cameron. Oh, go
Sorry,
ahead, Jeff.
really quick jumping in, because I saw a couple of comments in the chat, and this is going to be a few seconds on the back of what Cam said, because what he said was fantastic. One thing that I think we're trying to do right now is offer some of both. So Cam addressed this, that we had some feedback. All of our properties were leveraged, and people said they wanted opportunities to buy unleveraged properties. I think going forward, we're going to offer a mix of both. So, if if your personal risk tolerance thesis doesn't like investing in leveraged properties or wants all leveraged properties, I think we're working to make sure that our investors have a good supply of both. So you're going to have good choice as an arrived investor on which you want to do, what kind of properties you want to invest in. And that's Corinne. Also, you mentioned the filtering feature on our website. So yeah, I think you're going to be able to invest to match your thesis.
Wonderful. I know there's a few more things coming in chat. So Mohammed, if there is any further questions that you have, we're happy to tackle those live as well. Thank you for the color there, Jeff. Again, our goal is to provide a myriad of different properties in different markets and all of those things. Keep me honest here, team. I think we're in 20 different markets, a little north of 170 properties on the platform. How many do we foresee by the end of year, and what asset class do we have coming up? I'll start with you, Cameron, and then any color, Jeff, as normal.
Yep. We are expanding into short-term rentals very, very soon. And that'll be a large part of the expansion focus because we think there's a lot of great opportunities to produce higher income while backing it with the same residential assets that are very defensive kind of thesis in any sort of recessionary environment. So in terms of dollar volume, I think it's tough for me to articulate it in terms of homes because I think about it a little bit more in dollar volume because now we split it across different assets of deploying capital into both long-term rentals and short-term rentals. But I would like us to see a healthy mix of both and properties constantly on the site. It's one of the issues that we ran into in the earlier days of our operations is that we would kind of go dry on our site for a while where we didn't have investment opportunities. So in our growth phase, it's hard to say because we get surge demand a lot of the time. So, for me, I think about having a healthy pipeline of both assets at all times. And market expansion is also a big part of our focus because, a lot of our investors, they're buying every market that we're going to. Right. So and people are wanting to get that diversity. So, almost more important than the volume is the where and the what. So that's really what we're focused on is getting a more even balance of markets available as well as investment products, whether it be a long-term rental SFR or a short-term rental, vacation rental.
Definitely. Confetti's flying. We're very excited. Kimberly asked, Cameron, is Florida on the docket?
It is currently in the oven. Let's call it that.
Yes, that's a good way to put it.
Yep.
You heard it here first. So great question. We're very excited about Florida. I know there was a mention of what tax forms you'll receive. It's a 1099 DIV annually, which Jake dropped in there. There was a question about international investment, which Jake had also let us know. We're only open right now to U.S. residents and permanent residents over the age of 18. Our biggest barrier is figuring out taxes internationally. So we'll have more to come there. If you're open to it, please email support@arrivedhomes. Let us know where you're located, and we will continue to work through that on our side. So appreciate the feedback. There was one from Joe and Sean in here. And how much time do you give a property to fully subscribe? What happens if it doesn't get allocated in time? Cameron, before we get to that, there was a mention. Actually, we'll pause. If you could start with that one, and then I'll get to Sean's question.
Sure. Yeah. So I think the first part of it was what happens if a property isn't fully subscribed, or maybe how long does it take first? So most of our investments historically have, taken as few as a couple hours, all the way, as long as maybe 7 to 10 days to fund for the crowd. And then once we do have the fully, subscribed list, then we actually transact the shares for money. So that process again takes, call it a week. And that's when you would officially own the shares. And I think that, I'll pause there to say, that's how long it takes. But if it doesn't fully subscribe, which we haven't run into yet, we can do multiple closings. So let's say 90% of it is raised, but it's taking a while. we can close that, exchange the money for equity, then there's still an outstanding 10% of the company that is yet to be owned. But that's okay. That doesn't prevent operations. That doesn't prevent cash flowing. It doesn't hold anything up. It's just where's the relative ownership, and that's all. Then we would later have another cycle where we sell the remaining 10%. So again, haven't come across it, but I don't see it as any sort of there's no part of the investor experience that is really dependent upon that sellout speed.
Yeah, wonderful. Thanks for walking through it, Cameron. I know we have a part 2 to this, but I just wanted to give a shout out to Mohammed, who's an attendee today, helping answering questions in the chat. So you even beat Jake to it. So we appreciate having you here today and the engagement.
We're crowdfunded and crowdsourced for info.
Yes, we are. I wanted to highlight some feedback from Sean, because this will be imperative to bring back to our team as well. They mentioned one of the challenges I have with Arrived compared to other similar tools like Fundrise is I almost instantly see a return on my funds, although small to start. I see the growth. So is there anything on the roadmap to show ROI faster to investors? So Cameron, if you could walk through that. I think we did drop a poll as well on this, but would love to see your thoughts.
Yeah, as far as the ROI performance, we're, or visibility, let's say visibility into the ROI performance, because there's only so much that you can kind of force in a shorter timeline economically. Like we can't force the market with the macro environment, and we can pick great investments that'll perform over time, but in terms of that speed for which we're closing that feedback loop, I think that the things that we can do that we're currently like building infrastructure for is more frequent reporting on the economic side. So, for example, we could move towards updating our estimated third-party value of what the property is worth on a quarterly basis and go to a monthly basis. Or we can get dividends to go from a quarterly distribution to a monthly distribution. So there are ways to get the economic benefit quicker, such that it's not like kind of staggered out over time as much. But with that said, there's only so much that you can do to force the real world economics, but we can do more to increase the visibility into how value changes.
Definitely. Appreciate you walking through it, Cameron. I did see one from Kathy. Do you check into community crime rates? So Jeff, I'm going to kick that one over to you.
Sure. So we do look at a lot of sources as we're kind of vetting the homes and the areas. One thing I will say that kind of overlaps a lot when we were going through the school data, if you're in a 9 elementary school district, that's going to overlap heavily with inverse of crime rates, right? So you can use a lot of different proxies. Crime is part of some of the reports that we use and some of the data feeds that we use, data sources we use to determine whether or not we purchase. But I would say it's actually not one of the top 10, let's call it. It is something important to consider, but there's a lot of things you can use as a proxy for how good is this area, how safe is this area, how safe is my investment in this area.
Wonderful. Thanks for walking through it. I know we have a ton of new filters available on our website. If there's any you would like to see in the future, definitely let us know in chat as well. I'd love to get chat active in here and hear what cities you would like to see either a long-term rental or a vacation rental in. So feel free to drop that. We will definitely circulate it after. Kimberly mentioned California. Love to see it. So keep it coming. Southwest Florida, Evan, love to see it.
There may be some in the oven as well, Kimberly, in California.
Definitely.
Arizona too.
There's Arizona, Vegas. Yeah, love to see it. Park City, Utah. What are your thoughts on that, Cameron and Jeff?
Awesome market, but pretty expensive right now. So I think that you can be a big believer in it. The tough part is everybody's a believer in it and they want to throw money at it. So it's finding the right investment.
Definitely. All right, we'll get back to the questions. Maui, I think we should go to Hawaii ASAP. These are awesome. Do you still envision positive returns from capital gains? Wouldn't investors lose money with increasing rates and home prices correcting?
I think it's based on your time horizon. If you were looking to exit in 1 year or 2 years, I would probably agree with you that it's going to be tough to get the appreciation that we're looking for. I think if you can hold on as long as a real estate cycle lasts, then you'll have a lot more clarity on where you stand. But I think that that's a fundamental requirement of single family residential investing, is that you have to be willing to hold it long enough to play out the thesis, because a lot of the value proposition is loaded into the fact that it's a defensive play, that it is high demand, that even if everything else is going down, like in a recessionary environment, a financial market crash, real estate holds up pretty well. And I know that we have a little bit of trauma from 15 years ago from the Great Recession, but there's one of the differences that, as Jeff and I were talking about this one day, a phrase that he used that I really liked that stuck with me was that 15 years ago, the Great Recession was mortgage led. It was caused by real estate. This time it's not, nothing is caused by real estate. It's almost kind of like printing too much money, but it's a general economy and macro problem. It's a over leveraged problem for the country, for the government. It's not necessarily a real estate specific or real estate led problem. So as we think about the environment we're in right now, it all depends on your investment horizon, which is why we recommend that longer term horizon, to have this, to be able to defensively capitalize on SFR thesis and then survive long enough with the rental income and then get the appreciation when you start inverting the cycle on the upward trajectory again.
Wonderful. Thanks for walking through it, Cameron. I realized off of Sean's question earlier, one of the things they asked was, does the property still get rented out while shares are still being sold? Jeff, would you mind walking through that, what it can kind of look like for an investor?
For sure. So as soon as we purchase the property, we start working on managing that property. So we are working on it in the background as it goes through the processes, and as you are buying shares. I believe it in the future, it may even be possible to have a tenant already in the home before the shares are sold. So it's not, we don't wait for the property to get funded necessarily before we start looking for a tenant. So for sure, we rent it out as soon as we can, and we manage the asset as best we can to maximize that return even before it's fully subscribed.
Wonderful. Yeah, I believe it was the Daisy a couple weeks ago where it actually was on the platform, and then we had a tenant accept prior to the shares being sold out. So it can definitely happen. Great question, Sean. Keep us honest in the chat if we're missing anything here. I know it's quite active and we are human, so I want to be sure we get to everything. There was one in here. Is there a no tenant placement fee? This was from Michael. Cameron, can you walk through that one?
Yes. So there are tenant placement fees that the property manager charges, and that is one of the lifebloods of property management, is being able to collect on that fee. So we get pretty competitive rates, at least better than what you would get on retail. But that's why we factor in a 10% property management fee when we're underwriting, when many other acquisition shops would say underwrite it at 8%, which is only factoring in the monthly collection rate. It's not factoring in the effective rate when you throw in all of the other sources of revenue for the property manager. So yes, we definitely include all of those ancillary fees that would hit revenue, and we factor that into our underwriting.
Wonderful. I see one in from Mike and Cameron. Excuse me, Jeff. I'm going to throw this
Sure.
one at you. When you look at a sales price for a home, do you look at what it would cost someone to buy the home versus renting at the proposed rent price that underpins your NOI model?
Sure.
In short, oops, sorry. I was going to synthesize it for you, but I think you got it.
Yeah, that's a really interesting question. And sometimes that can even help us comp out rents when there aren't very many things for rent in an area. It's not a 1-to-1 ratio of kind of hypothetical mortgage versus rental rate. But we do consider that when we're buying. What is our theoretical underwritten rental rate versus what a hypothetical mortgage would be in a similar property in the area, because that is going to affect your demand for renting that property. So I think that is a very good observation, and it is something we certainly consider in our underwriting.
I think that the metric that we use that gets at your question, but maybe a little bit more actionable from a rental underwriting point of view, is we look at the rental to purchase price ratio. And I believe that effectively captures the trade-off that you are articulating in your question. Because when you're buying expensive property, you are basically making for a rental investment, you're making the calculation, how many dollars do I have to spend to buy it to generate how many dollars of rental income? So if we have a ratio of 200 to 1, you're effectively saying, I'm going to spend $200 today to be able to generate $1 of rent, for the equivalent. That's the ratio. And that to us is one of the biggest high level indicators of the cash flow potential of that property, because you want very good ratios where you can generate a lot of rent without spending a lot of capital. But there's a balance, because you don't want to necessarily be buying the absolute rock bottom cheapest asset that you can. In some cases you do, but it's sometimes it can be fool's gold. So it's not as simple of a trade-off in the sense that you just look for the best ratio all the time. It's contextual, but it's the metric that I think gets at what you're asking.
Wonderful. And I did see a question from Ellie about how many shares there are per property. So we're going to go live on our Harrison property page really quick before we move forward. So one moment here. I'm going to get this on here. So Ellie, and for everybody on the line, Harrison is what we just released today. So this is active on our invest page right now. If you scroll down here, I'm going to go slow so it doesn't give everybody a headache. If you go down to offering details, you will see the total shares for that property below. So just wanted to show kind of what that looks like. And I know we've been chatting a lot about our filters. They're available across the top here and also on that right-hand side. So you can toggle whatever you want to look at. It auto-populates for trending. So make sure to uncheck those so you can see all 173 properties. So cool. We will hop back into it here. I did see a question come in from somebody on the line. Is your property management maintaining the yards, or is the tenant responsible? Jeff, I'm going to kick that one over to you.
Sure. So while properties are vacant, we are responsible for that. And I believe in most of our leases, the tenants are responsible for maintaining once they are occupied. But as a general overarching rule, we as the owners are responsible for making sure that it is good, be it the tenant or landscaping company, so that we're avoiding HOA fees, things like that. So, yeah.
Wonderful. Thanks for walking through it. And there was one in from Kate. I know we talk about this on our traditional webinars often, but I think it's good to tackle why the 5 to 7 year investment period, and perhaps expanding on like why that's great. So I'm actually going to kick that over to you, Jeff. And then Cameron, if you have any color, I know you have a slogan for this, we can always get to you as well.
Sure. And I'm going to piggyback off something Cameron said, which is kind of investing with a longer term horizon and for a full real estate investment cycle. You need some time to let your thesis play out. I saw another comment in chat that I'm going to kind of loosely tie in here, who asked about some of our properties in Tennessee that were very nice new build properties, but in kind of rougher areas. And if you want to see your thesis play out, it's probably not going to be over a period of 12 months. You're not buying a house to flip. We are not, at least not yet, in our investments. We are buying houses for 5 to 7 years where we believe that we are going to see appreciation in those markets, higher demand for those kinds of assets. And that takes some time to play out. It also gives you time to avoid any kind of market noise, like, the Federal Reserve moving rates up and down really quickly, or the economy moving up and down really quickly after the pandemic. So I think 5 to 7 years is a good solid estimate of how long you're going to need to really let your thesis play out. And Jake also answered in the chat earlier, we are not 1000% married to that. It's not like we will never deviate from that if we think it's the right thing to do. But it's a good estimate of how long it's going to take for our investment thesis to play out.
Definitely. I think it's good to highlight a thesis could sell before, could sell after. It's all dependent on the data that the investment team is analyzing to support our investors in the best way possible. So Cameron, while we're on that, I did see a few questions on liquidity. So perhaps you could walk through options to date and what's coming down the pipeline. So I think that ties into a little bit of the thesis and a differentiation for exit.
Yeah, investor liquidity, it's tough with real estate because despite how liquid single family residential is, it is probably literally the most liquid real estate asset class on the face of the earth, like United States single family residential. And despite that, it's difficult to get cash to, when we say liquidity, we mean take an asset and turn it into cash, either through sale, through refinancing, some mechanism to turn it into cash. That's liquidity. And you can either refinance your home, you could sell it. And those are basically your two options in today's world. And with Arrive, we were trying to think of like, how do we do better than that? And, we have this concept of shares, and maybe we can do something with like letting people exit through redemption, where we would take your share at a market price and then sell it back into the Arrive community at the same market price, or something like that, a fair value at the time it's being sold. And we're offering that because we think it's just a better retail investment product, and we're in the process of getting that approved by the Securities and Exchanges Commission. And once that is approved, then we'll be releasing kind of our V1 of that program. So and just want to say appreciate your patience on that. A lot of people have been asking for it, and it's been a tough work in progress. But as we roll it out, I think it'll be very valuable to a lot of people who do need the money for emergency sake and things of that sort. So we think that it's just a better investment experience for the retail customer that you can't get in the real world, because like there's no an analog there. Maybe a home equity loan, but you're still taking out debt at that point. So not an easy way to do it without either taking out debt on your own or just getting rid of it and selling it.
Yeah, thanks for walking through it, Cam. I'm seeing a whole host of questions flow in. If we miss yours, we will definitely get to it. Jake, you're cruising through, so appreciate you. I see a few questions in here from Stanley, Jaden. It's all centered around tenants and vacancy. So Cameron, I'm going to kick this first one to you. Is Arrived Homes happy with how fast the homes take to rent? The rationale, is it taking quite a lot of time for homes to rent compared to my own experience? And I have to tailor that's compared to Stanley's experience. Right. So would love to hear your thoughts.
I think overall, I've been pretty satisfied with the leasing rate. There are a couple notable ones where the market changed and the asset just didn't have the market appeal at the price point, and we've had to make adjustments on that. So I would agree that there are a couple that stand out that would certainly impact the overall average. But for the Q2 and Q3 leasing speeds, so far we've been averaging about 14 to 17 days in our inventory that's been coming out in July. So I've been happy with that. We've been getting into a better groove with our property managers, and we're still in our first 15 months of operations, or 18 months of operations. So I think that there's still a lot of refinement to be done. Overall, I am happy, but really focused on the outliers and to use those as test cases to see like where can we improve the general offerings, because it's certainly a sore spot on an otherwise pretty successful portfolio, but I think it's also like it's not just speed, it's also the revenue optimization, and that's what a lot of what our team brings to the table, is that we're really experienced in finding what peak rent may be for a particular asset at a particular point. So I could lease everything much quicker, but then our yields are gonna suffer. So the art, in addition to the science, is really having that internal pulse for where the optimization point is, and we've gone through many hundreds of thousands of reps at our collective prior experience to kind of develop that sixth sense for it.
Definitely. Thanks for walking through it, Cameron. I did see one from Daryl about backgrounds. like we mentioned earlier, Cameron and Jeff both come from American Homes for Rent, which is the second largest family home rate in the US. We have a whole host of folks that have tech backgrounds and real estate, and they've been able to marry the two to provide access to real estate via Arrived Homes. So if you would like, we'll drop a link to kind of where our team comes from, as well as who has backed Arrived. It's really, it's been phenomenal to see all the growth. And like Cameron said, we're continuing to iterate each and every day and investing alongside you. So Cameron, we'll go back into our vacancy mode here. And I know you talked about this in our traditional webinar, but I think it's good to hit on. What is the Arrive process for finding tenants, vetting those options that we have? Some properties take much longer than others to start generating rental income. Oop, Cam, I think you're on mute.
The easier part of the question, as far as how we find tenants, or not easy, but just like kind of straightforward explanation, is that the property managers that we employ are responsible for the actual underwriting. So they have to follow the fair housing rules, the anti-discrimination, and all of the appropriate data processing. But we at Arrived and as the asset managers dictate the criteria for acceptance. So we set the credit scores, we set the policies on income, minimum income requirements, pets, any sort of dimension by which you could make an underwriting decision on letting a tenant in a home. We collaborate with our PMs to set that criteria, but they are the ones who are physically taking the apps, underwriting them, and creating the decision. The second question, some properties take longer than others to start generating rental income. I think there's going to be a couple of reasons that impact that. First, it's going to be the asset relative to the market at that time of year. So some assets are more seasonal than others. So larger homes, more expensive homes, they're going to be more seasonal in the sense that when demand is good, it's really good. When demand is low, there's nobody even looking at, for that house. So we're trying to make sure that we're getting the right properties at the right seasonal points in the year. It's still a process as we're opening markets, expanding into asset classes. Not every one of them is going to be, ending up perfect. Different management companies. But with that said, everything is getting in a tighter and tighter range of outcomes where it's following a process more. But certainly, even at American Homes for Rent, where we have 2,000 properties available at any given time for rent, you get a wide variety of outcomes. So it's just inherent with the business.
Definitely. And both Cameron and Jeff have agreed to go over time since we have so many questions today. So we want to support and be here for you. So Cameron and Jeff, so appreciate it. There's one more, Cameron, on this front. What is the rate of rental rate for Arrived Homes properties to date?
The rental rate. Okay, got it. Yeah. So for every property that has leased, it is about 45 days so far. So about a month and a half. And that includes the seasonal periods where people aren't shopping for rentals, or we've ended up with the big home at Thanksgiving when nobody's there. Everybody else is in their family's big home, not looking to rent one of our big homes. So we've ended up in that situation in our first year on a couple of investments. So again, re-diagnosing those and doing a better job of selecting the right assets in the right markets for the time horizon coming up.
Definitely. Thanks for walking through all those, Cameron. Jackie asked a great question. How often does Arrived or its partners actually get to see the property before purchasing it for investors? Or does Arrived only rely on data sources you mentioned for due diligence? So Jeff, I'm going to kick this one over to you.
Sure. So we certainly look at the photos, but I'm pretty sure they're referring to, boots on the ground. So we leverage inspection as well as, property management partners, or third-party partners that we may be in as part of the deal. So we do leverage some of our partners and inspections to really get a good look at the property before we wind up taking possession. So I'd say that's probably the main way we get exposure to it.
And part of it is also just the asset class that we're buying. Our average year built is 2015. So there doesn't tend to be as many issues. And if there are more issues, we've pulled out of plenty of contracts within the due diligence period because of termite damage or because of a fundamentally compromised foundation that can't be repaired. Those types of issues are the ones we pull out for. Otherwise, we tend to be finding investments that are newer, that will have a more predictable outcome in terms of the expense and the rehab. You know, our average rehab is somewhere in the neighborhood of around $7,000 or $8,000. And when you think about the square footage of the house at 2,000 square feet, we're at about $4 per square foot on the rehab budget, which is extremely light. You go to any company that's looking for these investment homes and they're putting money into it, you're looking at $8 to $15 per square foot. So they're buying those properties that really require heavy rehab. So in general, the inspection method and also utilizing our property managers to scope the property and get an estimate of what the cost is going to be before we even purchase it. Those are all tools to help us get an idea of the property condition when we purchase it. Otherwise, data does get you extremely far because the nature of the rental market for single family residential, it's not a complete commodity, but it has commodity-like behaviors because it's a necessity. Anytime you get to necessity type products, you get commodity-like pricing, food, oil, energy. It just transacts that way. So we can do a lot of damage from afar, but we do have the strategic points to say, like, inspect the house to make sure that there's no fundamental reason why we wouldn't want to buy it. And we do get boots on the ground for that.
Yeah, I appreciate you walking through it, Cameron. I remember, I think we were talking about this recently. There was a home that you ended up finding termites during the inspection process and actually walked away just because there's too much overhead that would take place. So definitely appreciate you walking through it. I see a few more questions popping in through chat. One is from Brian. Do you follow the data saying renters are leaving markets? The examples they gave are Charlotte and Atlanta, and that they're heading into smaller metro markets. Cameron, I'll ping that one over to you.
In general, I buy into that thesis. And it's actually a reason why we like somewhere like Chattanooga. Because if you looked at that map, and Jeff started, like, I think the first fact that he said was, it's an hour and a half from Atlanta and Nashville. And it's pretty close to Birmingham and a couple of other major, like, tier 2 cities as well. So we do subscribe to the idea that today's modern environment and work from home allows, like, a lot of the tier 2 and tier 3 cities that are close to their, big brother, tier 1 cities, they're going to be the beneficiary of flexibility. So many people can have that hybrid working schedule now that as long as there's infrastructure there and there's enough, like, you don't want to go into a 200 person town and be like, there's a good investment. It's the next big, that you're risking too much at that point. But if there's other signs that there's infrastructure there and that, you can kind of grow a town exponentially near there, like it's got freeways. Is it connected to the interstate freeway system? Because if you have a lot of connections there, even if you don't have a big population, like, that's a very good sign. Like, you want to be defensively located by big cities, by big infrastructure, because everything gets transported along the freeways and Amazon trucks. Like, you're a good strategic spot to be in if you have that infrastructure there. So we do look for that. And we also look at patterns like people leaving, what was the headline? You would leave San Francisco to go to a different tech city, either Miami or Austin, right? That was like the headline for the last 2 years during the pandemic. So 100% I, take the philosophy that follow where people and wealth distribution is occurring. And that's where you want to be.
Definitely. And I think that, Cameron, that plays directly into the slide that Jeff shared during the prepared remarks when he was highlighting the Harrison. And on there, we had Google, we had an Amazon fulfillment center, all sorts of different major highways, an airport. So a myriad of different vessels that bring in jobs and infrastructure. So I think of, like, if you're comparing, Southeast Ohio to a Columbus, I would err for Columbus being, a place where we would have a property versus Southeast Ohio, where it's, very rural. So appreciate you walking through it, Cameron, and obviously what you had shared earlier, Jeff. Or was it, did I miss something? Or was it a yeah?
Just a yep.
Sweet. Awesome. There was, I know Cameron, a couple weeks back, you walked through the state of the market, and would love to unpack this a little bit. So can you please address investing in the current environment? Housing prices went down by 1% from June to July this year and are expected to go down more. So wouldn't want to lose our shirt investing now.
Yeah, I certainly the timing is always one of the paramount concerns with investing, right? And after having been in real estate and tried to do a couple of savvy things with crypto and losing my shirt, I realized that time in the market is better than timing the market. So I take much more of an approach of dollar cost averaging across a lot of different markets as the preferred way to play a down cycle. So my recommendation and what I'm personally doing is, instead of trying to catch the knife and when you think you hit rock bottom, then throw all your money in, I would just spread it out. So if you wanted to invest X dollars, maybe don't throw in X dollars in the next 6 months, allocate X dollars over a 3-year period and do it evenly. Because also, with specifically to Arrived, as time goes, Arrived product offerings will get broader, and it's more and more likely that we'll have something that fits exactly what you're looking for. So I would retain your time option. Don't deploy all your capital immediately, but maybe avoid the other end, which is trying to time the bottom exactly, because very few people can do that and it's hard. But that would be my recommendation on how to invest in a market that feels like it's not clear that it's got, that it's on an upward trend.
Yeah, Cameron, I think the theme we think about that is diversification as a whole. So not having all your eggs in one basket. So great question. I did drop a resource that we have from our Learn Center in there as well for you and for everybody on the line. So great question. One flowed in from Mohammed. I think this is a combo question, Jeff and Cam. So does Arrived face any resistance from a community when trying to buy a property or properties in that specific neighborhood?
Yeah, it's usually kind of black and white in terms of either you can or you can't. So I'm sure that there are instances of kind of bullies in the neighborhood that don't like renters, but we haven't come across a systemic issue resulting from tenants who are not welcome there. Certainly there's problem tenants, which the neighborhood may not like, but that's more about the tenant as opposed to the idea of being, a rental. So no, I don't think it's of any paramount concern. And additionally, we tend to be seen as good actors because when we buy a home, we send a letter to the HOA, we introduce ourselves, we say, hey, this is our program. We look for 2-year tenants. We, have these sorts of underwriting criteria. So we've actually gotten some favorable responses from HOAs because we're not quite the big institutional landlord that, is operating without a face. We have a much more high touch program. One, because of our size, and two, I think we're being very intentional about it as well. So I don't run into resistance from HOAs other than when the rules are the rules and you can't rent, there's no budging there. So they're not forgiving at all in that sense, which is why I say it's a very black and white thing. You can or you can't. And that's about it.
Wonderful. I realized I missed a question that was way up the line from Joe. So we're going to pop back up there. WeWork's Adam Newman's new company is Flow, purchasing rentals to build community. Do you all foresee this as a direct competitor for Arrived as a whole?
Cam, I'm pretty familiar with this one. I don't want to call myself an expert on this, but I have heard a lot about this recently. So I believe what he's trying to do is he's trying to take multifamily units and he's trying to have a branded living experience. So he's trying to have a consistent branded living, like apartment experience across tens of thousands of apartments across the country. So you feel like you're living in a Flow apartment anywhere you would live in those sets of apartments. I don't really think that's going to compete with a lot of it. Certainly, I don't believe competes with any of what we've currently put on our platform. In the future, it may be something we obviously consider if we decide to go towards multifamily or something like that. But as it stands, I don't think that is something that is competing with us. I do actually think that it does sort of validate our overall thesis that larger money is coming into this kind of space, and this asset class is going to continue to grow and expand. And as you know, as long as people in general begin to think of real estate more and more like an investment, I think that's good for Arrived, and it's really good for our investors because they own a part of that asset class.
Definitely. Go ahead, Cameron.
Yeah, and I think as far as like direct competition for Arrived, we're in very different business models, right? Arrived is focused on providing access to real estate investment opportunities. Where the competition will exist through investment into rental communities is there will be more rentals, therefore rents will be harder to push in some areas where there's saturation. So there's just going to be more supply. Now, I do think that macroeconomically, we are moving towards a rentership economy where more and more of the population is opting into rentership as opposed to homeownership, whether it's forced or whether it's intentional, opted into. Regardless, you will need higher supply, right? So which dynamic ends up winning out, more supply or more demand? I'm not exactly sure, but certainly it does add supply. So it makes competition for rentals even more fierce. Now, with that said, what'll happen? It'll be reflected in the investment economics. So rents will go down or prices of properties may go up. One of those two things will happen such that yields come down. And to the point where Arrived investors say, I'm looking for something a little bit better now. And we'll get that market signal from our investor base saying they want something different. Maybe it's more of a focus on short-term rentals. Maybe it's a focus on flips, doing land development, something. But that's how we think about Arrived, is that we are a company that is focused on providing access to all sorts of real estate investments. And it's a growing asset investment product class that we're offering. But we're not directly in the business of being reliant on tenants to pay for the Arrived business model. But, underlying all of it, the rental industry is extremely important to the assets we buy today, but that can change going forward.
Definitely. I want to say too, there's a myriad of different fractional investing platforms. So we always recommend doing due diligence on which one aligns with your investment goals as a whole. So Cameron talked a lot about, diversifying across different properties. You have the option to do that in the market as well. And we are grateful, to the investors that we have to date and those that are yet to come with our expansion as the doors continue to open. So I did see a mention, great feedback from Tom, and Mohammed jumped in. We do send out email updates when a property has been leased. However, would love feedback on different statuses you would like to see. I would say we toggle the line of not overwhelming all of the, tenants, trash, taxes, all those different details, but would love your feedback on what might be beneficial for you as a whole. So keep us honest in the chat there. Oh, we were just talking about this internally, Jeff, so I'm going to kick this one to you. This one is from Brian. I saw a couple homes in Nashville, the Kenny and the Dolly, beautiful, that look like new builds that are surrounded by what look like rundown properties. It seems to be the outlier for homes you offer. How did you decide on that area?
Sure. And I think I touched on this a little bit in the time horizon discussion. But when you think about all the really big built up cities that you just off the top of your head, the Bostons, the New Yorks, the San Franciscos, the really big coastal cities, the suburbs, the immediate suburbs, the stuff a few minutes from downtown, 50 years ago, 100 years ago, did not look like they did. They do not look like they do today. And so when you're trying to evaluate a thesis on something like the Nashville properties, yes, you're not going to be able to buy something right downtown that looks like that. The thesis is that those kind of houses are not going to be available for those kind of prices going forward. And if you wait until the entire neighborhood looks like that, you're going to be paying probably double or more than you're paying today. So again, that's not a price prediction. That's more of just understanding fundamentally the longer term thesis that you're taking by investing in things like that. As Nashville builds out, as more and more jobs, as higher tech companies move there, and there's higher educated, higher income jobs, those people are going to demand higher level houses, and they're going to want them close to work, which eventually those streets that currently may not reflect the same asset quality as we purchased there will begin to. And again, if you wait until everything already looks like that, you're probably going to be paying a substantially higher price for something like that.
The land value for those homes are going to go up significantly over time. So the people that live there currently, they almost aren't going to be able to afford to not sell and capitalize on it. So as Jeff said, eventually, it is where you want to be, but we've seen direct evidence within that first ring in Nashville, like that whole ring is improving. There's so much development work that goes on. Otherwise, yes, I would have hesitation for the exact reasons that you mentioned, but there's just too much momentum right now that we've seen with our own eyes to kind of stop the land appreciation kind of play that's happening right now in Nashville.
Yeah, definitely. And I did see some feedback around Tom, I know you mentioned about going over the line. I think would be helpful, Cameron, is can you ever, if you've invested in a property, can you receive dividends even if the property has not been rented?
Yeah, totally. And it's very intentional that we actually do that, because part of what we are providing is the stability of the dividend. So we underwrite for an initial vacancy period. We build a cash reserve for this. We have utilities to pay. We make up for it though later on when we're collecting rental income and there's no expenses. We're still refilling some of that to go back into the cash reserve to pay for future vacancy cycles and additional unforeseen maintenance expenses. So it's a feature as opposed to a bug that you get rental income even if it's not rented, because we use that reserve as a buffer to facilitate the stability of that payment, which we think is a preferred experience, as opposed to maybe not getting anything for a month and a half or two and then building up and getting a lot of cash and then dropping off. So we just prefer to stabilize it as an investor experience to communicate what the expectations are, so it's not so volatile.
Yeah, thanks for walking through it. Keep us honest in the chat. I think we have roughly 6 more questions before we close out at 30. There was one from Anthony. As a home buyer, the inspection report is a key detail to understanding the property and any potential issues. Is this something you share with investors so to know the condition of the property, especially since some properties are older versus new construction homes? So Jeff, I'm going to throw that one to you.
Okay, I may wind up passing that one to Cam, just because I'm not. Yeah, I'm gonna pass that one to Cam.
Easy.
Yeah, so as far as sharing with it, it is something we've discussed. Currently, we don't provide like the full underwriting package, but duly noted on the feedback of what kind of issues we're seeing, and so you get some comfort that they're being remediated. I will say that every time an issue does come in, we do put together a repair request package and like send it back to them. So we're often getting credits that will help pay for the actual remediation of the property when we own it, or they end up just fixing it. So it is getting implemented and actioned on, but it's a good call out to see if we can develop a resource to provide for investors on each one.
Definitely. There was one that flew in from Abby. Do you require the tenant to get renter's insurance with $1 million liability? Cam, I'm going to throw that one to you.
No, certainly not $1 million liability. Some of our property management companies do require that renters get renter insurance. It's odd. We've seen both owner requirements as well as property management mandates. So there are reasons to, have both. I can make an argument on both sides. One, I see it as a friction to leasing. So if somebody wants to rent a home, but then they have to get renter's insurance, maybe they wouldn't. On the other hand, I think that having renter's insurance, when you do need it, you'll be glad that you had it, because it reduces the legal complexity of who owes who money, or at least there's generally not as big of a concern. So I would say that we have a split policy right now, and we're working with our property managers to figure out if there is a policy that we want to articulate as owners that go one way or the other, because there's good arguments on both sides.
Wonderful. Thanks for walking through it. I saw Bill had mentioned that they would like to see inspection reports. Appreciate the feedback in here. I think there was another thing we just updated, like you saw those filters, but I believe Sean would like to see that in a bigger view. So we'll take that back to our product team. We could before, but with the recent update, we took that out. So appreciate it. There was one that came in from Mohammed. Many properties recently showing dividends below historical return. Why is that? Cameron, I'm going to kick that one over to you.
Yep. So there could be two reasons primarily. With the historical returns for homes that are not levered, it reflects a pretty significant change in the market that happened in the first 6 months of this year. Basically, as interest rates were going up, kind of unintuitively, home prices were accelerating even faster. And you wouldn't expect that to have the same relationship. But the idea was this: people quickly saw the window closing on them at which they could lock in a cheap mortgage. So there was a rush to buy anything you humanly could, not because you cared about the purchase price of the home, but you cared about the payment that you locked in on the mortgage rate. So that created this escalating like frenzy of activity to just like get whatever you could at the time. So unfortunately, that resulted in higher sustained prices for what we see today. Now, can that change? I think that's a nice point that goes back to one of our other investors' questions earlier about like, should I invest now? I think Lord M had asked this question, and he said, why invest into a recession? I said, okay, well, maybe slow down then. And that would be the advice. So historical returns it's just a market change that we saw. The other reason why you could see lower historical returns is that on some properties, we are still implementing leverage because of some of the reasons that we stated earlier. But the leverage environment, the interest rate environment today is much higher than it was a year ago when we were having also mortgaged properties. So that difference in the interest rate is getting subtracted out from the returns on the dividends. And that's why you would see something like a 2% or 2.5% dividend. It's because we're on that investment in particular, we are going for the levered equity appreciation. You know, we're doing it. So we want to get the balanced cash flow, but we took out the leverage on it. So naturally it'll result in those lower dividend yields because of that higher interest rate.
Wonderful, Cameron. Thank you. One came in from Bill. And Jeff, I'm going to kick this one to you. I just looked at homes in the area of the Harrison, which we showcased earlier today in the prepared remarks. And most similar homes are selling for under $400K. Why buy this expensive home in that specific area?
Sure. And so this is this is probably a little bit longer answer, and I know we're coming up on 12:30, so I'm going to try to keep this brief. I think the key word in your question is similar. And one of the reasons this business is so difficult is similar and comps and things like that are very difficult to suss out. And so without being able to go and evaluate the property right now and look at the other stuff on the market, I will say that there are a lot of reasons that something could be on the market for $400,000 in the same area that might look roughly the same and is just 700 square feet smaller, or is built 10 years older, is a 10-year older property, or is a brand new build but it's smaller. So there's a lot of things you can look at when you're trying to compare the property. I would say that given the size of our property and the upgrades in, it was certainly worth the purchase price, and I think it was a good buy. So again, really hard to evaluate without kind of apples to applesing it, but I certainly don't think that most things in the neighborhood would be $400K. Our property in particular, one little nuance point is that it's a 3-bedroom 2,700. So in the future, if we were looking to sell, we could easily add a bedroom and make it a 4-bedroom 2,700, something like that, which I think would add a lot of purchase price on the market. So there's things we can do to help investors kind of like maximize that purchase price.
Wonderful. Thanks for walking through it. Sean, I saw you had, when I started on the platform, you were talking about going to monthly payments. Currently right now, dividends are sent out on a quarterly basis, distributed back directly to the bank account you have connected. I know we are exploring monthly. We did drop a poll about what you would like to see in the future. I know we've had a lot of feedback around wanting to mirror what you would see as a property manager on that monthly cadence. So like Jake mentioned, that is something that we're working on behind the scenes. I'm smiling because I love seeing y'all's feedback and questions align with what we're doing internally. So keep it coming. I see one other question in here that Cameron, it's from Lord M, that I'm going to kick right over to you. What is your average vacancy rate per year? And what is the average duration of leases? 1 year or more?
Yeah, the vacancy rate per year, it's going to be really tough to say because we're not stabilized yet, right? So when you buy the asset and then you rehab it, you're going to have a naturally longer vacancy period. I'll tell you what we underwrite for, and then that will tie in with the average lease rate. And I think it'll make it a little bit more reasonable. So the second answer to your question is 2 years. What's the average duration of leases, right? And it's actually probably more like 20 to 24 months for a very strategic reason, because we try to have all of our expirations occur in the higher peak seasons. So if we happen to rent a property out in November, I don't want a 2-year lease that ends in November. I'd actually probably prefer more of an 18-month lease that ends in April, right? So getting me there, that last 6 months is not worth it to me on the additional duration, because the risk outweighs that benefit by dumping me into a vacant period when we're going to have Thanksgiving and Christmas, within a month of each other. So that's the problem with, some of the metrics right now of saying like it's not stabilized, but we underwrite for half of a month per year. And, back to what I said in the very, very beginning is that we kind of look at things and average them out to an annualized rate, even though the event itself is not occurring every year. So it's not literally that we are getting a new person, like we are vacant 15 days per year. It's more like we're vacant 45 days per year every 3 years. And that's how we get to that. So the longer lease period of that 20 to 24 month period is a very strategic and intentional part of what we do to make sure that we are minimizing that vacancy period by biasing towards the tenants who are more committed, as evidenced by signing that long dated lease. So unfortunately, I can't give you that great answer, but I can give you a reasonable answer of what we intend it to be, paired with some assurance that the operational plan meshes with that idea of how to lower the vacancy.
Wonderful. Cameron, thanks for walking through that. I think we got through all the questions. If
Woo,
we,
nice.
That was a lot. It was like rapid fire today. If we by chance missed any of your questions, feel free to email support@arrivedhomes.com. Happy to cover. Also dropped a link to our landing page. We will have a webinar tomorrow at 1 p.m. PDT. Feel free to join that as well. We're happy to answer there. Jake, thank you for rapid fire in the chat. Cameron and Jeff, so appreciate your time. We're going to see Jeff on even more webinars in the future. For either of you, any closing remarks before we shut our virtual doors for the day?
Y'all brought it with the questions. So great to always interact with an engaged audience. And thanks so much for your time on a Thursday afternoon.
Yeah, thanks for joining and thanks for all the great questions.
Wonderful. Thank you all for attending. We did release more properties this week. As the team mentioned, we will be releasing vacation rentals next month, so stay tuned, and we will catch you all later. Have a great day.
All right. Thanks, everyone.
Thanks, everybody.
Bye, everybody.